Hello, I'm Panicos Demetriades. Thank you for inviting me to your conference. The title of my talk is Outlook and Challenges for the Global Economy in the Euro Area. The first thing I need to say is that I'm using the World Bank's report, Global Economic Prospects, to get all the forecasts out. Now, the reason I'm doing that is that it is very timely. It was only published on the 14th of June, and that makes it the timeliest of all the available forecasts that come from the big international organizations. And timeliness is very important, especially during the pandemic, because as we see, we have news every week, and sometimes this news mean that policy towards the pandemic changes, and those policy changes, either to do with new variants or to do with flare-ups, they can influence the forecasts. And as you'll see that the forecasts are now slightly better than they were at the beginning of the year, and that has to do with the fact that the rollover of the vaccines is going better than expected, especially in advanced economies. So World Bank, and that's because it is very timely. In fact, we are very lucky. We only published it on 14th of June, and that's just 1 week from today that I'm recording, and 2 weeks before the start of your conference. Now, when it comes to the euro area, I'm also using the forecasts of the ECB, and they are Eurosystem forecasts. They were made available just before the ECB monetary policy meeting of 10 June. And again, those forecasts, compared to the March forecast that they published, have been revised precisely because the world economy and the euro area are growing faster because of the successful rollout of the vaccine, the better than expected rollout. These were my choices before I wrote the lecture, and I thought it's useful to show them to you. The IMF, which is obviously a very authoritative source, published its World Economic Outlook in April 2021. So that's 3 months out of date. Normally that's not a problem, but in these circumstances, as I explained, because of all these uncertainty surrounding the pandemic, it can make a difference. The OECD published their forecasts in May 2021, and again, they're not as up to date as those of the World Bank, which is 14 June 2021. Okay, so that's the introduction, and this is a slide with the outlook for real GDP growth across the world, across advanced economies, emerging and developing countries, and then there's a memo paragraph for world trade volume, oil prices, and non-energy commodity prices. So the first thing we note here is that the global economy was in recession in 2020. The growth rate was minus 3.5%. And that's a big change from growth of 2.5 in 2019. So the World Bank is now expecting that this year we'll see 5.6% growth, and that's quite high. It's a bounce back. It's a very healthy bounce back of the global economy. And then they expect a slowdown to that growth to 4.3% in 2022 and to 3.1% in 2023. Now, as far as advanced economies are concerned, they go from a recession of minus 4.7% to positive growth of 5.4%, and that's led by the US and the UK that have around 7% real GDP growth, which is quite high. The UK, however, saw a recession, the deepest recession among all the advanced economies, nearly 10% contraction of GDP. So this bounce back doesn't really cover lost ground fully. When it comes to 2022, advanced economies are expected to grow by 4%, and then that growth rate is going to slow down to 2.2% in 2023. Okay, so emerging and developing countries, they also saw a recession in 2020 of 1.7%. For China, that was 2.3% plus, but 2% growth rate for China is a recession by normal standards in China. I have added two countries that may be of interest to you, Turkey and Poland. I couldn't add all of the countries, but I thought that those are two examples. And we see Turkey um, had a slowdown, 1.8% growth, but it's also expected to bounce back this year. Okay, and Poland is kind of similar to the euro area, obviously. It's very closely linked to the developments in the euro area. When it comes to world trade, we have a contraction in 2020 by 8%. That's a very, very sharp contraction in world trade. But all the lost ground is expected to be regained this year. And then we have more growth next year, 6.3, and then a slowdown to 4.4%. Oil prices, as you will know, have been particularly volatile. They contracted by 1/3 last year, but they are bouncing back very strongly this year. That's led to concerns because they have more than recovered their lost ground. It's been an increase of 50%, but part of that is base effects. It's expected, the growth rate in oil prices is expected to slow down in 2022, and then just a very modest growth of 0.9% in 2023. Non-energy commodity prices have also been relatively volatile. We've seen a very large increase this year, and I'll try and explain why and why the World Bank sees that there will be a slowdown, a slight slowdown next year. So they see this as fairly temporary, and a further slowdown in 2023. This shows us where output is relative to where it was before the onset of the pandemic in 2019. Okay, starting here with 0, we see that the world has seen this global recession of around 6%, and then we have the bounce back this year and further positive growth next year. We see that the red line, which is the advanced economies, is a very similar contraction and a much sharper increase this year and next compared to the world. EMDs, that's emerging markets and developing economies, have contracted by a similar rate as the rest, but are recovering more slowly than the rest of the world. And the last was the low-income countries that are not expected to recover in the forecast horizon. In this slide, we see that the revisions to the forecasts relative to vaccination progress. So this is basically telling us that countries that have vaccinated above the median, whether they are in the world or advanced economies or EMDs, are doing better than the below median countries in relation to vaccination. Okay, so they are growing faster. So vaccination explains the bounce back, basically. That's what this slide tells us in a nutshell. So if you're making good progress with vaccination, then you see your real GDP growth bounce back faster than the countries that are not making as much progress. And of course, that relates to the restrictions that are imposed by the governments to deal with the pandemic. This is trade, global trade rebound, and why is it basically not rebounding fast enough. Although goods are rebounding, we have that goods that have fully covered the ground. Okay, so by March 2021, trading goods is doing well, but trading services is not doing as well. It's not fully recovered, and that's to do largely with travel, which is still not even 50% of where it was before the pandemic. Now, these explanatory notes tell us that the rebound has been achieved, obviously, for goods trade. We can see that. Um, but it's also telling us that the pandemic is making changes to how we trade, and it's accelerating those changes in the supply chains. For example, we've seen regionalization of production networks and increased use of digitalization. Now, there are supply bottlenecks, and they are caused by restrictions and what is going on in the supply chains in relation to the pandemic. And these graphs here tell us about delivery times. That's this index here relative to pre-pandemic times. So these have grown, obviously. Delivery times are slower than they were during the pandemic. It takes longer to ship things. And these are container shipping rates, these are the costs, and they have increased enormously. And of course, you will know that. Although they fell during the pandemic, we can see now that they are more than 2.5 times what they were um, during the pandemic, so 250%. So the index here is 100 before the pandemic and 250, around 250 now. These are the container shipping rates. So, okay, so, and these are the causes. Manufacturing trade is being constrained by the supply bottlenecks, and there are also localized shortages in shipping containers. When it comes to global services, sea transport, telecommunications, financial services, international property, business services have all recovered. Other services haven't yet, but they're quite close. And travel is way, way below everything else. And of course, that's understandable. The travel industry is the one that's been hit most during the pandemic. People are just simply not traveling anywhere near as much due to all these travel restrictions, obviously. And this is a chart of the global survey expectations for international tourism to return to pre-pandemic levels, and not many people think that 2022 would be normal. Only around 15% of the respondents, but more than 40% of the respondents think that 2023 will be the year that will have full recovery. And in fact, around 40% think that it will be 2024 or even later. So things are not looking good for the travel industry. And that kind of explains also the forecast in relation to demand for energy, right? So this is the next slide, and it tells us about commodity prices, including energy, metals, and agriculture. And the most volatile, of course, is energy, and we all know that. We had a very big drop in 2020, and then in the first half of 2020, and then we have had a rise since then, and now we have prices above where they were initially before the pandemic. Although we're having this 50% growth, much of it is just base effect, it's just catching up. But now it's above what it was, but not by 50%, by a lot less. We see metals prices also have increased sharply, and agriculture, food prices have increased quite a bit. Now, obviously, what explains energy prices partly is demand and partly is supply. And of course, supply, we know, is in the hands of OPEC plus. So their continued production restraints are what explains this very steep recent rise, but the production cuts are gradually being reduced. And in fact, there were bank things that there is a lot of spare capacity, and this is a graph that shows the spare capacity in different countries. And the expectation is that all demand will increase, but it will not regain its pre-pandemic level, and that's where the travel industry predictions are relevant. They're not going to jet fuel consumption is going to remain subdued. There's no doubt about that. And at the same time, we're going to have production increases by OPEC plus. And in fact, if anything, the risks could be downward to oil prices. Because if the speed of production increases is high enough, prices could start falling. So I don't think that energy prices should be a big concern, that we're going to see very rapid inflation in energy prices. So that kind of explains to some extent why central banks are saying that the current stance is okay, that they don't need to do much yet about inflation, because the spike we've seen recently is to do with commodity prices, energy prices, and those spikes are transitory, they're temporary, they're not gonna last. How about risks? And let's start with the downside risks. And a lot of those risks related to the pandemic, obviously. And there could be new variants. We're already seeing one new variant causing havoc in some countries, and also now very present in Europe and the UK. We don't know how the vaccines will work with that new variant. In fact, there isn't enough studies to show us how effective the vaccines are with the current variant that is circulating. And then there could be these flare-ups in different parts of the world. So there are downside risks relating to how the pandemic develops. And of course, if things get worse, then we're going to see restrictions reintroduced. There are also downside risks relating to financial markets. And that's because of the increase in debt, the accumulation of debt by governments, or the fiscal stimulus that they put in place to support companies, firms, and households during the pandemic. It led to very large increases in public debt. And corporates also have borrowed more to get through, and all that is creating a debt mountain, and we know that debt mountains can lead to crisis. And in fact, in emerging markets and developing economies, there have been credit downgrades for nearly 40% of their countries since the beginning of 2020. So things are not looking good when it comes to debt. So that's a big risk. Then all that fiscal support could also lead to rapidly rising inflation. And that rapidly rising inflation, particularly in the United States, where inflation is now running around 5%, that could lead to monetary tightening. In fact, there was an announcement a couple of days ago by the Fed that unnerved market participants, that they could be actually tightening sooner than people thought. And then, of course, if the United States tightens, that would have spillover effects on the rest of the world. So again, that's a source for downside risk. Inflation in general, the increases in inflation could mean that inflation expectations are de-anchored, and that in itself can have negative effects, and it could affect currencies, and it could affect some countries more than others, especially those countries that have borrowed heavily in foreign currency. And then last but not least is the global banking system. It started the pandemic with strong capital buffers, but many banks are now vulnerable to corporate defaults. Right? So if those corporates start defaulting, then we could have a new banking crisis, or we could perhaps see a slowdown in lending, and that can be bad. Right? If they have weaker balance sheets, then the things that banks will do is to reduce credit availability. So even if banking crises are avoided, we could have problems there. There are, of course, upside risks, and the upside risk is a quick end to the pandemic at the global level, and that's to do with the supply of vaccines. It seems to be better than was expected, so countries could send advanced countries could send their vaccines elsewhere, their excess vaccines elsewhere. So the policy challenges in this climate is, first of all, to make sure there's enough vaccines and an equitable vaccine distribution, because we need the whole world to recover from this. If we keep some parts of the world that are not vaccinated, then obviously that could lead to new variants, and could lead to flare-ups, and they could spread. Okay, so we need to do this together as a world. Of course, economic policy actions need to find the right balance between support and normalization, and the timing there is critical. We're having debt accumulation, and if this continues, there will be more debt accumulation. If this support continues, we're having weak productivity growth. We need to address that. But if the support is removed too early, then economies can suffer setbacks. So they have to policymakers need to find the right balance. They need to obviously be concerned about macro stability, about inflation, about high public debt levels, but at the same time they have to continue supporting the economies while we're not out of the woods. And then how do you do longer term growth? There have to be some structural reforms. In advanced economies in particular, we are beginning to worry about emerging inflationary pressures, so that they are posing new challenges, especially for monetary policy. And I'll talk more about that during the last part of my talk, which would be about the euro area. This slide shows basically that we're still not out of the woods in a nutshell. So World Bank thinks that monetary accommodation is still essential to cement a strong recovery. Okay. This slide relates to non-financial corporate leverage, and we have comparisons with the global financial crisis. We have the United States, and we have advanced economies. And what we can see here is that it's worse than the global financial crisis leverage, right? And both for the US and for advanced economies. So we are concerned about the banking system, right, and corporate insolvencies. Fiscal policy challenges, there are many, and we've seen sharp rise in public debt in advanced economies. This is advanced economies, and United States in particular, very sharp rise in public debt. Comparison with the euro area and the GFC. This is the United States, this is the euro area. You've seen that it's been massive increase in fiscal support in the United States during the pandemic, and much higher than it was during the global financial crisis. And the same is true of the euro area, although the levels are much lower. So we see here that there is a bigger challenge for the United States when it comes to fiscal policy normalization than in the euro area. This is a fiscal balance, so it's the fiscal deficit. Euro area and United States. Euro area is the red line, and you see that it is better. I mean, the movement is pretty similar, but the level of the deficit in the euro area is lower than the United States. So I'm going to talk more about the euro area now. And these are the forecasts of the European Central Bank and staff forecast of the euro system released in June 2021, and these were the forecasts in March 2021. So you see that they went up from 4.0 for real GDP growth to 4.6. So 0.6% revision, and that's to do with the rollout of the vaccine, the successful rollout of the vaccine in the last 3 months in the euro area. And that continues into 2022, that 0.6% uplift in the forecasts. And there is an uplift also in inflation projections. So inflation is now expected to be 1.9% this year and 1.5% next year, compared to 1.5% and 1.2% respectively in the March forecasts. But it is still within target. So this tells us there should be no cause for concern, especially if you look 2023, 1.4%. In fact, it's going down in the medium term, the inflation rate. So this is telling us that what we've seen recently is just simply base effects, supply bottlenecks, one-offs. It's a spike in energy prices, but it's not expected to have a permanent effect on inflation by the ECB. And this is what people see sometimes, and they get worried. They see 2.5% or 2.6% inflation. And they think that inflation expectations could be de-anchored. But look at this. The ECB is expecting inflation rate to decline and to sort of stabilize around 1.5%. In fact, that's significantly below the target of 2%. Just a couple of words about the framework. As we all know, the target is 2%, and this is how it's interpreted by how price stability is defined by the Governing Council. The secondary objective of the ECB is, of course, to support the general objectives of the Union. That's a bit broad and vague. And in a Bruegel report published very recently, which I've authored, we're suggesting that secondary objective needs some guidance, or the ECB needs some guidance on the secondary objective. The ECB is an inflation targeting central bank, and they respond to shocks as and when they occur, taking into account all economic and monetary policy developments. At the moment, the ECB is undergoing a review of its monetary policy strategy, which has been in place for 20 years. And we are expecting some changes. I think they will be minor, but they could actually affect this definition. I think it's going to stay at 2%, but it's going to be symmetric. It's not going to be below but close to. It's going to be just symmetric. Some general information about inflation targeting, historical, started in New Zealand in 1988, then 3 years later, Australia and Sweden followed, UK followed nearly 10 years later. Typically, we have inflation targets of 2%. It serves as an anchor, and that's the most successful thing that inflation targeting has done is it has anchored inflation expectations around that level. And of course, monetary policy has to respond to shocks as and when they occur, and that's this subordinate decision. And that's a quote from Mervyn King, the former governor of the Bank of England. Inflation targeting requires the central bank to be independent, and that's because governments, politicians have low inflation credibility. We don't really believe them when they say they're going to deal with inflation, because they would always be tempted to inflate before elections. So independent central banks are designed to be free from those political pressures because they're not elected, and their reputation depends on delivering low and stable inflation. This is a commercial break. This is the cover of my latest book. And it goes on about the ECB's independence in practice. So besides monetary policy, I would argue that the ECB in 2012 saved the euro with the whatever it takes and the outright monetary transactions program that followed. It's been accused of mission creep, and there are many legal and political challenges because of that. It took part in the Troika during the crisis, but also bought bonds of distressed countries. So there's been a lot of debate around that, and of course a lot of accusations. So Madame Lagarde has many challenges ahead. Now, I hope that gives you the context for this current monetary policy stance. And the current stance is accommodative, very accommodative. Policy rates remain low, 0% for the MRO, and minus 0.5% for the deposit facility. So when banks put their money in the ECB, at the ECB, they're penalized by 0.5%. Forward guidance, they basically tell us what they expect those interest rates to be, and they're expected to remain low, right? So the stance is going to remain accommodative. Until that time that those forecasts are showing that there are inflationary pressures in the medium run. So we expect monetary policy to be accommodative. Now, in addition to interest rates, they obviously have done a lot of quantitative easing, and they are called non-standard measures. The Pandemic Emergency Purchase Program is a massive envelope of 1,850 billion euros, and we're told that this will continue. The purchases under the PEP will continue until the end of March 2022, and in any case, until they believe that the coronavirus crisis phase is over. But even when they stop buying bonds, they will reinvest the principal payments until the end of 2023 at least. So they're not going to start selling those bonds too quickly. So you shouldn't worry about those effects, that they would be flooding markets with bonds. That could cause instability. So they would take their time. There are, of course, other non-standard policies in place because interest rates have been very low, very close to the zero lower bound. So they were doing quantitative easing, more traditional quantitative easing under the APP. And what they're doing now is that they're not buying new securities, they're not buying assets under the APP, but they are reinvesting those that they had bought before. And they will continue doing that until they start raising interest rates. So first they will start raising interest rates, and then they will start unraveling the QE of the past. They will continue doing longer-term refinancing operations that support bank lending. They're called TLTRO3, and they're specifically targeted to bank lending to firms and households. So that remains in place. And then they are also making a call about fiscal policy stance. They're saying that support should not be removed prematurely. So they are concerned that governments may remove fiscal support prematurely. Okay? So this concludes my talk. Basically, the key messages are that the global economy is bouncing back more rapidly than expected at the beginning of the year, and thus to do with good progress in vaccination programs in advanced economies. We have seen a spike in energy and commodity prices, but we think that that's relatively temporary, and we're going to see normalization in 2022 according to the forecasts. We have obviously seen supply bottlenecks, OPEC plus production cuts, and base effects, which explain why energy prices are 50% higher than last year, because we had a very large reduction in oil prices last year. Okay, so we are seeing inflation pressures in advanced economies to be re-emerging, particularly in the United States, where inflation has reached 5%, which is the highest level since 2008, but not as much in the euro area. So there could be tightening of monetary policy in the US. That's not unlikely. So when it's going to come, it's not obviously not certain, but 5% inflation, unless inflation starts declining soon, could lead to some action there. GDP projections have been revised upwards in the last 3 months, and that's because of the progress in relation to the vaccination programs. The second takeaway is that uncertainties remain, and they're big uncertainties. We really don't know what will happen with this virus, unfortunately. And all these new variants, we don't know how effective vaccines are going to be. And there could be even more new variants by the autumn. So I do think that the third takeaway, which is about inflation, at least insofar as the euro area is concerned, you shouldn't be worried. Inflation is not getting out of control. I believe the ECB monetary policy stance is appropriate, given where we are, given that we're not out of the woods yet. Thank you so much. I'm now ready to answer questions.